Broadcom Inc. ticker symbol Avgo is currently trading at $211 a share. It is up almost 17%. Oh, it's still going up 17.15% in the pre-market. And the reason for this is they just had earnings and the shares have rose. Well, as you can see, it was 13, now 17 on profit beat and massive opportunity in AI. Broadcom reported better than expected fourth quarter earnings. Broadcom has seen soaring demand from the generative AI infrastructure, and the chipmaker said artificial intelligence revenue increased 220% for the year to $12.2 billion. So what we're going to be doing is looking at these latest earnings, seeing why the stock has gone up, and then seeing if Avgo is a buy or a sell using my automated stock valuation spreadsheet. We'll be seeing if we'll be putting in these latest numbers and then seeing if it is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. If you're interested, check my Patreon, but let's get straight into it. So, as I said, here we have the fourth quarter and fiscal year of 2024. So we'll just scroll down a little bit here, get rid of the fluff, get right to the stuff. We have year ended here and then the fiscal quarter prior 2 quarters. Net revenue is up 14 billion, up from 13, up from 9.3, and the fiscal year 35 to 51 billion, so that is up massively. Next, we'll look at net income. Once again, we have the years here. So net income is down slightly from the prior year, 14 to 5.8, but they were down in the prior quarter, 1.8 billion to positive 4.3, so that is excellent. And finally, free cash flow. If we just scroll down here, we will see the cash flow statement. Free cash flow is cash operating activities minus capital expenditures. Operating activities is up 14.8, 14.9, 5.6, and in the full year, 18 to 19.9. CapEx is relatively low, actually decreasing 122 million. So that gives us a value. Well, what we'll do is we'll go to my sheet and we'll put in these numbers. So if I put in Avgo, this will load all the latest company financial data, and then we can override using the values that we've just gone through there. So if I put in the revenue here, so the trailing 12 months was 46.8 billion, and if we put in the most recent number, which was 14.54, 51.6, then net income was 4.32 billion. Net income is now 5.9, so that is up trailing 12 months, which is what we want to see. And then for the cash flow from operating activities, it was where's it gone? 5.6 billion, and capex was 122 million, so it brings us 5.5. So free cash flow is up as well from 13. Oops a daisy. Doing the wrong things. Oh, let's try it again. Oh, there we go. Too many shortcuts. Yeah, so 5604 minus 112. So let's have a look at these. Revenue, all-time highs, 51 billion, up and up and up and up. Exponential growth, that's why the stock is up. Net income, yes, down slightly, but overall, they're more interested in the revenues and the growth. Free cash flow, up as well, all-time highs. Operating cash flow is up as well, which is why they're quite bullish. Shares outstanding, relatively flat. Not going to look too much in that. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows, discount them to today's value. Currently $140 a share. The price would be 212. But with sort of these ratios at 60 and 80, it's not really going to like the stock. But if we have a look at these numbers and see what we expect, analysts are saying for revenue growth rates, 61 and 69 billion actually, so they're a little bit more bullish than even we are. So let's bring this up to about 18%. That puts us to $158. Net income margins all over the place, though. I'll take an average of these last few years. Yeah, 27%. Brings us up to 175. And then free cash flow rate, well, it's all over the place here. I think we'll keep it at 200, but it does put at 175. Also, we'll use the WACC here, weighted average cost of capital. Brings it down ever so slightly. So yeah, discount free cash flow doesn't hate the stock as much as I thought. Quite interesting. If you're interested in buying the sheet, check out my Patreon. You can help me out for $1.50, buy the sheet for $4, or if you want the higher tier, which includes me doing reviews, then $7. But let's get back into it. Dividend discount model, they do pay a dividend. Yeah, the growth rate on this is probably higher than the weighted average cost of capital. So realistically, yeah. Once again, dividend discount model doesn't really work for these kind of stocks. But Ben Graham formula for intrinsic value looks at the expected growth rate of a company, AAA bond yield, corporate bond yield, which is at 5.14%. Analysts are expecting growth for Avgo, for Broadcom, at around about 27% in the current year and 18% in the next year. So if we see, once again, doesn't like it. Now the reason for this, low earnings per share, $1.53. So finally, let's have a look at the comparable company model. This is a way of valuing companies, looking at the competitors. We'll look at revenue growth rate, EBITDA, net income, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, and PE. So we won't do NVIDIA yet, but we'll do AMD as one. Next we will do QCOM. And finally, Texas Instruments we compared to last time. And this will load all the company financial data for these companies. Oh, I didn't. Texas, TXM. Oh, let me just get the ticker up for Texas Instruments. TXN Instruments, that's why. There you go, loads it eventually when I give it the right data. So, enterprise value, Broadcom is the largest, revenue it is the largest, growth rate second highest, only AMD is higher, EBITDA highest, net income second highest, profit margin one of the lowest but higher than AMD, price to sales it is one of the highest, price to book one of the highest, PEG, Peter Lynch's price to earnings growth, above 1, ideally one that's under 1, AMD is under 1. EV to revenue, EV to EBITDA puts it $140 to $114 a share. P, one of the highest PE ratios, but forward P is lower. But this does give us an implied stock price of 120, so a little bit overvalued. Now, if we were to compare against more of a, I'll say AI hype stock, but obviously it is not really at this point because it's one of the largest companies in the world. If you brought in NVIDIA in there and were to compare just AMD and NVIDIA, still, interestingly, slightly overvalued. With the current price is at around about 210. Oops. And this puts it anywhere between 150 and 206. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check my Patreon, and I'll catch you guys next time.